All right, so now that we've discussed how to record depreciation, we're going to deal with asset impairments on the financials. An asset impairment would exist when the asset is not expected to generate sufficient cash flows to at least equal its book value. In other words, the future benefit provided by the asset is not greater than the value we have it recorded on the books for. So the first step to test for impairment is to estimate future cash flows and then compare those estimated future cash flows to the net book value we have the asset recorded on the books for. Estimating future cash flows can be challenging because you're predicting the future. For classroom purposes, we're just going to give you the number to compare to the net book value. If the net book value is greater than the estimated future cash flows, then the asset is impaired. To figure out the amount of the impairment loss, we have to compare the net book value to the fair value. The fair value is going to be effectively the present value of those future cash flows. Again, it's not anything that we have to calculate. We'll go over the concepts of present value in a later chapter, but for now, just know that if you determine that the asset is impaired, the impairment loss would be the difference between the net book value, which would be given, and the fair value of the asset, which would also be given. It's very similar to the lower of cost or market rule. So if we have an impairment loss, it means that the cost that we have recorded on the books is higher than the market. And that's the same situation you would have with a lower cost or market rule for inventory. How do we deal with that impairment? Well, let's look at an example. If Southwest did an asset impairment and identified an aircraft with the following information, they had a net book value of $10 million, estimated future cash flows of $8 million, and a fair value of $7.5 million, the first step is to compare the net book value to the estimated future cash flows. And because the net book value is greater than the estimated future cash flows, it means we have an impairment. Then to figure out our impairment loss, we compare the net book value to the fair value, which is a difference of $2.5 million. So to record it, we're going to record a loss of $2.5 million and then a decrease in the flight equipment's asset value of that same amount. So in our accounting equation, losses are like expenses. So that goes up 2.5, which makes net income go down 2.5, and therefore our equity go down 2.5, and then our assets go down 2.5. So this ties into the conservatism principle. If we don't think we're going to get a future benefit that's more than the value of the asset recorded on the books, we need to record that loss now, not wait until the future. Once we are done with our assets, we're going to dispose of them, and that may be that we just throw them away or give them away, and it may be that we sell them. So how are we going to deal with that on the financial statements? Well, the first step is we need to update depreciation expense through the date of disposal, and then we record the disposal by recording the cash received or paid. If we have to pay off somebody to take our asset, that's not common, and then we write off the accumulated depreciation and record up any gain or loss. The way they describe it here makes it sound complicated. I'm going to make it nice and easy for you. So what we're going to need to do when we get rid of the asset is get rid of the accumulated depreciation account. So we're going to do that by debiting the accumulated account, which reduces accumulated depreciation and in turn makes assets go up. And then we're going to credit the asset to get rid of it. And then we're going to debit cash if we receive cash. And then to make our journal entry balance, we're going to either end up debiting a loss if we need a debit to balance, which would increase expenses, or we credit a gain if we need a credit to make it balance, which is like a revenue. So to kind of give you an example with numbers, let's say we went through the process and we determined we got cash of 100. The accumulated depreciation on our asset was 50, and then the equipment balance was 200. Well, we have 150 on the debit side, 200 on the credit side, so then to make it balance, we're going to need a loss of 50. So that's what I mean by you record a loss or a gain in order to make it balance. We can also calculate our gain loss using a formula. The gain or loss is the selling price minus the book value. Remember, the book value is the asset cost minus the accumulated depreciation. So in my little example, the equipment had a cost of 200, accumulated was 50. So the book value would have been 150. We sold it for 100, and lo and behold, there's that $50 loss that is automatically recorded when I did my journal entry. So if you remember this generic formula, that'll get you through any disposal transaction, and the formula should make sense. If we get money, money go up. We got to get rid of the contra asset. To get rid of contra assets, you debit them, and then to get rid of assets, you credit them. Then if there's a difference between my debits and credits, I either am going to result in a debit to a loss or a credit to a gain to make it balance. Here's some more practice. So Southwest Airlines sold flight equipment for $11 million cash at the end of its 17th year of use. The flight equipment originally cost $30 million and was depreciated using straight line with zero residual value and a useful life of 25 years. So the amount of depreciation expense recorded at the end of its 17th year to bring depreciation up to date would be, well, if it's straight line, it's the same amount every year. So that would be the asset cost, which is $11 million, minus the residual value, which is 0, over the estimated useful life of the asset, which was 25. And that's going to tell us the depreciation we would have recorded each year. I'm sorry, I used the wrong number. The cost was $30 million. We sold it for 11. So 30 million divided by 25 gives me 1.2 million. Too many zeros. So we have 1.2 million would be the depreciation that we need to record to get the accumulated depreciation up to date. Should have just waited for the answer to pop on here, all nice and pretty. So that's how we get the 1.2 million. And then the next step says, after updating the depreciation, what would be the book value at the end of the 17th year? Well, if you remember back to our discussion on depreciation, you certainly don't want to create a schedule going through 17 years of calculations. But because it's straight line, it makes it easy. It's 1.2 million a year, and we've had it for 17 years. So you just take the 1.2 million times 17, because straight line is the same amount each year, and we determined that the accumulated would be 20,400,000, or 20.4 million. And then the next step would be to calculate the book value. So I jumped the gun and circled my 20.4, got sucked into the drug dealer. So to get the book value, that's the accumulated depreciation. The book value would be my cost minus my accumulated depreciation. The cost is 30 million. And the accumulated is the 20.4, which leaves me with a book value of 9.6 million. So the correct answer to this, if I read it carefully, is A. The first thing we do is get our accumulated, which is that 20.4 million. Then we have to calculate our book value, which is the 30 million minus the 20.4 million, and that gets us the 9.6. So then it wants to know if we have a gain or a loss. So to figure that out, I could do one of two things. I could do my gain or loss formula or my journal entry. Let's start with the gain or loss formula. So the gain or loss formula equals the selling price minus the book value. The selling price is the 11 million. The book value is that 9.6 million. So we're going to end up with a gain of 1.4 million if I did my math right. To confirm that, we could do our journal entry. So the journal entry would involve debiting cash for the 11 million we received, crediting the equipment for the cost, which was 30, debiting the accumulated depreciation for the amount of accumulated depreciation, which was 20.4 million. And then we have to determine if debits equal credits. 20.4 plus 11 is 31.4. That doesn't equal 30. So in this example, we're going to need a credit to make it balance of 1.4. And lo and behold, that is our gain. So either way you do it, whether you use the gain-loss formula or you do out your journal entry to record the disposal, you'll arrive at the same conclusion, which is that we have a gain of 1.4 million. Here's the calculation using the formula that arrives at the 1.4 million. And then here we have our journal entry. So to record the depreciation expense in the final year, we debit the depreciation expense to make it go up and credit the accumulated by that 1.2 million for that 17th year of depreciation. And then we record our disposal, just like we did on the previous slide. Cash goes up 11, accumulated is going to go down by 20.4 because it's a contra asset. To make it go down, we debit it. The equipment goes down with a credit for 30, and then to make our journal entry balance, we're going to end up with a credit being needed, and because it's a credit, it's a gain. Because gains are like revenues, they go up with credits. If it were a debit that was needed, it would be like a loss, because losses are like expenses, they go up with debits.